An IPO is an exciting time for a company. It represents years of hard work and sacrifices finally paying off. It serves as a way for companies to raise capital to expand even further, and it also provides the early investors a way to cash out and enjoy the fruits of their labor. But not all IPOs are sunshine and rainbows. Some have caused companies to go from being worth billions of dollars to being worth X to nothing. Today, we're going to be looking at the worst IPOs of all time. Okay, so this one might be a shock to you guys, but hear me out. Facebook, or Meta as it is called today, had a pretty rough IPO. Even though if you invested in it and held it on to this day, you would have made a lot of money. When the company went public in 2012 on the Nasdaq, it was far from perfect. It experienced trading glitches because of the heavy trading volume, and there was also concerns about the valuation as analysts wondered about the company's ability to monetize mobile advertising. The stock went from its IPO price of $38 to $18, a more than 50% drop in the price. If you invested into the IPO, it would have taken you a year and a half to get back your money. But it would have taken you even longer if you invested in the Robinhood IPO. Just like Facebook, Robinhood IPO'd at $38. But here's the problem. They IPO'd during the meme stock frenzy of 2021. 6 months before the IPO, there was a short squeeze where retail investors revoltedly short alerts of GameStop stock and sent the stock price soaring. Robinhood infamously restricted trading due to a clearinghouse liquidity crisis. Not only that, but when the company filed its S1, which is its prospectus to potential investors when it goes public, they had to settle a backlog of regulatory complaints and had to pay a $70 million fine to FINRA to settle charges regarding system outages and misleading options data. On the first day of trading, the stock was down 8.4%, and later on it had a rally as they ironically treated it as a meme stock. But afterwards, the stock price tanked to as low as $7. After adding new features and revenue sources, the stock made a recovery. However, it would have taken you 3 years to recover your initial investment in the IPO. Anyways, let's move on to Uber. Uber revolutionized transportation as it was the first company to introduce ride sharing, and it disrupted the taxi industry. Now, despite it being an innovative service, does not mean it had a stellar IPO. In 2019, it went public at an $80 billion valuation, but was suffering massive losses and an uncertain path to profitability. Almost immediately, the stock fell, went from $45 a share to $41.57 a share by the end of its first day of trading, a 7.6% drop in the stock price. It fell even further months after the IPO before it made a recovery. So now let's talk about Vonage. So some of you guys probably haven't heard of this company, but Vonage at the time was a company that provided residential broadband voice over IP phone service, which basically is being able to talk on the phone over the internet. Before the IPO, they offered stock to its existing customer base. The company went public on the 24th of May 2006 at an IPO price of $17 per share and raised $531 million. However, when it started trading, it plunged 24% on the first day. Then there were lawsuits about how the stock was distributed. The customer base that applied for the IPO didn't receive their shares until after much of the stock's value was wiped out. The company later did get bought out for $6.2 billion at $21 per share, which is around 24% higher from its IPO price. But speaking of companies that eventually recovered, Groupon was not so lucky. Back in 2011, Groupon was one of Silicon Valley's hottest startups. The company popularized daily deals by allowing customers to buy products and services at massive discounts while helping local businesses attract new customers. Investors loved the idea, and the company went public at an IPO price of $20 per share, giving it a valuation of almost $13 billion. However, after the IPO, cracks in the business model started to appear, competition increased, customer growth slowed, and many businesses realized that constantly offering huge discounts wasn't that sustainable. Within a little over a year, the stock had fallen below $3 a share. While Groupon still exists today, it never managed to live up to the expectations investors had when it first went public. Now, we can't have an IPO flop video without mentioning a .com company. So basically, during the .com bubble, investors believed that almost any company ending in .com was destined to become the next big thing. One of those companies was eToys, an online toy retailer that aimed to compete with traditional toy stores like Toys R Us at the time. When eToys went public in 1999, the excitement was unbelievable. The company priced its IPO at $20 per share, and by the end of its first day of trading, the stock had closed at $76 per share, after reaching as high as $85 during the trading day. Despite the hype, the company was burning through cash trying to expand while competing against established retailers and eventually Amazon. When the dot-com bubble burst, investors quickly lost confidence, and less than 2 years after its IPO, eToys filed for bankruptcy. Now, as bad as eToys was, web fans somehow managed to do even worse. The idea behind the company was simple: order your groceries online and have them delivered straight to your home, which sounds pretty familiar. But back in the late 90s, it was way ahead of its time. The company raised hundreds of millions of dollars from investors and built expensive warehouses and delivery infrastructure across the United States before proving that the business could actually make money. When Webvan went public in 1999, it was valued at around $4.8 billion, but the company was losing money at an alarming rate. Less than 2 years later, it filed for bankruptcy after burning through $1.2 billion. It became one of the largest business failures of the dot-com era and a textbook example of the dangers of expanding too quickly. Now, this company right here became a symbol of the dot-com bubble. It was Pets.com. If you've ever seen that famous sock puppet mascot, this is the company behind it. The business sold pet food and pet supplies online and spent millions of dollars on advertising, including a commercial during the Super Bowl.
Hey man, I'm getting car sick. I think I'm gonna boot.
The problem was that shipping large bags of pet food across the country simply was not profitable. The company was losing money on almost every single sale, and no amount of advertising could fix that. Pets.com went public in February 2000 at $11 per share, and just 9 months later, the company shut down and liquidated, making it one of the shortest-lived public companies in history. Investors who bought into the hype were left with next to nothing. And finally, the worst IPO flop of all time, WeWork. At one point, WeWork was valued at an incredible $47 billion. The company marketed itself as a revolutionary technology company that was going to change the future of work. But when it filed the paperwork to go public in 2019, investors finally got a closer look at its financial statements. What they found was not pretty at all. The company was losing billions of dollars. Its corporate governance raised serious concerns. Many investors questioned why it was being valued like a technology company when it was essentially renting out office space. The backlash was so severe that the IPO was cancelled altogether. Its valuation collapsed from $47 billion to around $8 billion in a matter of weeks. The CEO stepped down. The company would eventually go public via a spot merger. However, in 2023, it would eventually file for bankruptcy. So all of these examples basically just goes to show that just because a company is highly anticipated doesn't mean it is a good investment. Sometimes by the time the public gets the opportunity to buy shares, the hype has already pushed expectations far beyond reality. That is why it is very important to do your own research instead of blindly following the excitement surrounding an IPO. If you enjoy this video, then don't forget to leave this video a like. Don't forget to subscribe to the channel, and let me know in the comments, what do you think is the worst IPO of all time? See you in the next video.